Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena, I would like to talk about tax reform. Now, if people hear about the word tax reform, most of us interpret that to be, rising taxes. Okay, what new taxes or higher taxes will the government introduce, and how much more tax will we need to pay? There's this debate going on at the moment because the Federal Treasurer, Jim Chalmers, has said, well, the budget's unsustainable, and we need to start considering tax reform. Now, of course, he said this 2 or 3 months after winning a federal election. Certainly didn't want to mutter those words before the federal election. But Australia's been sort of criticised by its over-reliance on income tax. And I was kind of interested to read a report by an independent think tank called the Australian Institute. Now, the first thing I do when I read a report is have a look at who funded it, because that's key, right? It's interesting to know they are independent, and when you look up who are the major donors to this institute, nothing really sticks out that, could be of a concern. So I think we could probably at least there's nothing that suggests that we can't rely on the data. Anyway, when you just look at the total income take, in terms of taxable income, profits and capital gains that are charged to individuals, Australia, from a developed nation, is the 5th highest. So the only one higher, the countries higher than us are New Zealand, Iceland, the US and Denmark. Denmark is certainly well and truly the highest. Now that doesn't make us feel very good, and what we're really, the answer is about 39% of individual income is paid in tax, which is a very high rate of tax. Now, so on the face of it, you go, okay, Australia's too reliant on tax, but really what it doesn't take into account is other countries charge social security contributions. So whether it's the US, you've got to make a contribution towards unemployment, or whether it's a thing like Medicare that we've got in Australia. And then the other thing too is other countries also, you've got to make contributions towards pensions. Certainly in the UK, that's the case. So if you're going to get a government pension, you only get it if you've made contributions throughout your working life. A little bit different to super, but it's, again, just another way of, taxing people. But once you factor all those contributions in, and the fact that, okay, yes, in Australia we've got to make super contributions as well, we're actually below the OECD average. So I guess, when we have this debate around tax reform, it's good to, make sure we're actually looking at the data, the facts. And when you look at those facts, you say, well, Australia's not too heavily taxed. The problem, though, with income tax is that it's not really great for the economy, because what you really want people to do with their money is either spend it into the economy or invest it. And that's really how you're going to grow an economy, either through the economic base expanding, or you're making investments, which again, hopefully the economic base expands. Whereas if we pay it in taxes, yes, sure, it can be redistributed through government spending, but there's no debate to have here around how economical government spending is. So what we want to do today is share some ideas that we've been thinking about that might, that sort of throw our hat in the ring, so to speak, in terms of adding to this debate around what sort of tax reform we might need. So we'll take it in turns. The first idea that I want to share is talking about a luxury rate of GST. So, GST was introduced in year 2000 at 10%, it's stuck at 10%. There's certainly countries that have a value-added tax or a sales tax that charge more than 10%, but 10% isn't too bad. It's not like it's too low relative to other countries or too high. But what it doesn't, I don't think it's a fair tax. I think what we need to do is, and other countries have done this too, is have a luxury rate of GST. So for all goods that are non-discretionary, things like food, utilities, these sorts of things, a 10% flat rate is fine. But for luxury services or goods, perhaps we can charge a higher rate of tax. And the idea behind changing GST would increase GST revenue in return for reducing income tax rates. So I propose that on the basis that is the condition, that obviously income tax rates come down. Now, the benefit of income tax rates coming down means that higher income earners will have more after-tax income. They will either spend that or they will invest it. But either is good for the Australian economy. One of the criticisms of consumption tax is that it's regressive, in that if I earn $1 million, I'm probably not going to spend that full $1 million, going out to restaurants and so forth. And so the amount of GST I pay, even if I'm paying a lot at a higher luxury rate of tax, relative to my income, is small compared to someone that maybe earns $50,000 and they actually need to spend all their entire income, probably on non-discretionary items, so they'll pay a rate of 10%, $5,000, but relative to their income, it's relatively high. So it is regressionary, I acknowledge that, unlike income taxes, but we've really got to make sure that Australia is going to grow, and we've got to benefit from our growing population, and the best way to do that is really through a consumption tax, especially if we don't necessarily trust the government to spend it as well. By paying more income tax, sure, they've got more in their coffers, but whether they're going to spend that in a way that's going to grow the overall economy and make Australia, I'm not going to say make Australia great again, but make sure Australia is making the best of its opportunities, is something that I'm less optimistic about.
So the next item is around your main residence exemption. Now, obviously, and there's a lot of sort of news in the media and so forth around, the baby boomers, people of Stuart's age when they came in the 1920s and so forth, buying up, a lot of land and property in Australia, and obviously they're sitting on sort of gold mines as it stands. Now, it's going to create a whole bunch of generational wealth, and there's not many things that in life that are tax-free, and we believe that the main residence exemption is too much of a free kick, especially if you're sitting on one of these gold mines. Now, if we're not saying that it should be removed in its entirety, but definitely cap it. Cap it to a certain degree where, if it's a couple of $1 million that you've made tax-free as a result of the capital gain, and then you get a further 50% discount for anything above that, then you're still getting quite a good free kick there, and you're still getting a lot of after-tax proceeds as a result of that disposal. And it should be sort of comparative, I believe, to what a replacement asset would cost, because at the end of the day, a lot of these people will be downsizing, and they would like to downsize in similar based suburbs and so forth. So it should be done in indexed format, in my opinion. So cap it, and it's not a once off cap. It's just something that should be indexed on a yearly basis to go in line with basically how the property market sort of appreciates.
And the other thing too is to make sure it doesn't stifle transactions in the property market. So you don't want to introduce a tax and then people feel like they don't want to sell. So in the UK, that's what they did. They introduced much higher rates of stamp duty for people that are selling higher value properties. So the stamp duty on if you sell something for £1.5 million is like 12% in the UK, and as a result the market's just grinded to a halt. No one wants to sell, no one wants to have to pay 12% to get back into the market. So it's important that we don't have a tax system that discourages changes of assets, because then you get underutilisation of assets. You'll get people that are living by themselves that probably should be downsizing but they don't because of cost. But the point here is the main resident exemption is uncapped. And when someone sells their mansion for $100 million and makes a huge capital gain, maybe they should be making a contribution to the tax pool. The next one is the $3 million cap on super, when tax on unrealised gains kicks in. So that is anything above $3 million is taxed at 30%. Obviously this has been well publicised, and we'll record a podcast episode about it if and when it becomes law, but obviously that's going to be a problem as well. One thing we need to really think about in the debate around tax reform is how effective is it going to be. So it's a similar example in the UK where you've got inheritance tax. The reality is that the UK government doesn't raise a lot of money related to inheritance tax, and the reason for that is that people plan around it. Same with France. France also has a really prohibitive inheritance tax, and what happens is, as I understand it, most parents start giving their assets to the children well before they pass away. And the same thing's going to happen with this $3 million cap on super, where unrealised gains kick in. People will plan around it. Sure, some people are going to be caught by it, but for the most part, it's so unpalatable that people will plan to make sure they never pay the tax. And that's the thing about consumption tax, right? If you want to go to a restaurant, you're probably not going to decide not to go to that restaurant just because you're going to pay a slightly higher rate of GST. You're still probably going to do it, and the whole economy benefits.
So the next thing that the government can potentially think about is furthering the CGT discount for investors who provide benefits to people who are sort of renting below market value. So obviously there's a bit of a rental crisis as it stands, people getting priced out or not getting the accommodation that they need or require for their family. There's a lot of competition and so forth. So the idea is behind, it was almost taken from what New York really does, is around if you've got a rent controlled building and you provide sort of discounted rent, then the state government provides them with additional benefits or additional tax breaks as a result of that. So although you're still getting the capital growth, you're still getting a bit of a tax break as a result of discounting the rent for those sort of underprivileged people who can't actually pay the rent. So, the proposal could be something along the lines of, instead of getting a 50% CGT discount on the disposal of the asset, it might be 60 or 70 as a result. We don't have a magic number, but it's more so along the lines of helping out the economy to get into or solving the rent crisis, whilst still allowing investors to be well rewarded for investing within their own in Australia.
So there's some of the ideas that we think we can contribute to this discussion around tax reform. I think that the thing is, what we don't really want to see happen is they just play around the edges. They just move a few rates, introduce a few different things, but nothing materially really changes. If we're going to have this debate in Australia, I think we've got to be open to more significant changes. The other thing too is, if we grow the economic pie, then the tax revenue will naturally grow with it. And I think as a government, that is the best way to build a really strong, financially stable government, is if you're growing your economy, then your income, your tax income will naturally grow in line with that. So thinking about what sort of tax system can we have that attracts investment, that attracts more spending, that attracts overseas investment as well, because Australia is very small relative to the developed economy, less than 2%. So we still need, investment in Australia, to build our country. These ideas aren't perfect, and I don't think there's any perfect solution here. But again, just something for us to think about. And as we talk about it at our dinner parties, which I'm sure dominate Mena's conversation at home, we can talk about, our ideas for tax reform. Okay, until next week. Bye for now.